Hello there and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. So let's just start as always by having a quick look at the, the risk warning. If I could just ask you to take a few moments to read through it, and I'll put myself on mute whilst you do that. Okay, so without further ado, let's crack on. So we've just had the US non-farm payrolls on Friday. Just worth having a look at where we are as we head into the weekend and ahead of the coming week. So as far as the dollar is concerned, we've seen continued weakness in the US dollar. It's just, we've got that bearish engulfing candle. We're just testing that 97.50 level. And this is basically following the US non-farm payroll report, which came in weaker than expected at just 22,000 jobs created. Fourth straight month that jobs creation was below 100,000. So this is no longer considered a one-off. It is a clear deterioration in the labour market, as with the unemployment rate, which rose to 4.3%. So this was very key for the market, and we've seen the US dollar come under pressure on expectations that the Federal Reserve will not only cut rates in September by 25 basis points, may do so by 50 basis points, and are expected to cut rates on several occasions across the end of the year amid that slowing in the US labour market. Now, the S&P 500 did actually rise to a record high following the data. Why can't I put it up? Just bear with me one sec. There we go. This is the S&P 500, so briefly rose to a record high of 65.30 following that data as rate cut expectations surged. But then we've seen a spike lower, or a pullback, should I say, and actually trading down on the day. And I'm guessing this is more to do with concerns over actually the deteriorating outlook, and the fact that the Fed is in a bit of a difficult situation in the sense that it's got sharply deteriorating jobs market, but we're also seeing inflation tick higher. Now, we will come to inflation shortly, because there is indeed US inflation data next week. So that is a concern that's driving the markets, because at the end of the day, these are two opposing policy reactions that are needed to deteriorating jobs market and to higher inflation. So that is what's unnerving the markets. As I said, we've seen the S&P 500 rise to a record high, but it has since fallen lower. And the other one that's really worth looking at is gold. I mean, gold is through the roof. It's risen to a fresh record high, 3,600, really breaking out of range, showing few signs of holding back. We are obviously deeply overbought here. When we have seen overbought sessions on the gold, we do often get a bit of a pullback, so that could be an opportunity to buy in. So economic calendar, let's take a look at what we'll be watching for the coming week. Oh, just bear with me. So we're going to be having a look at what's going on next week. I think over, oh, there we go. Next week, as we head into the second week of September. This is indeed the first full week for the US after we had the Labor data, Labor Day holiday. So we could see a sort of return to more volatility and volumes and liquidity across the market. So a couple of things we're watching out for over the weekend. We do have the OPEC meeting. There 8 ministers are, the OPEC Plus meeting is taking place on Sunday. Let's just bear with me. Just going to pull up oil for you. This is the oil chart. So we've got the OPEC meeting coming up on Sunday. We've seen actually oil prices, as you can see here, have fallen across the week ahead of this meeting. A couple of things at play here. The group is potentially going to be discussing whether to keep oil production unchanged in October or raise output further. Now, reports have surfaced this week that the group could consider unwinding an additional 1.65 million barrels of oil per day of outcuts, which would equate to around 1.6% of global demand. And that would be a move more than a year ahead of schedule. Now, OPEC had already agreed or have been increasing output by 2.2 million barrels per day from April to September, as well as an additional 300,000 barrels per day from the UAE. So this is as the group looks to increase their market share. Obviously, the prospect of a supply glut has pulled oil prices lower. This week, we also saw inventory data show that oil prices came down. And then we've also got these concerns over the health of the US economy. So there's this potential supply glut at a time where the US economy appears to be slowing. And so we're testing that 61.60.50 level, which was the low that we saw in the mid-August, or in fact the August low. Bearish engulfing candle, so it's looking fairly bearish. If we get a break below that, we've obviously got momentum on our side here to take things lower. So then if we get a break below there and the 60 round number, which is just below, then that could actually open the door to a deeper decline towards the $55 level. So that's going to be one to watch. Any recovery is going to need to rise above this level here, 63.25, and then obviously the 65 level as well. We get above there, then we might be able to get a higher high and expose 200 SMA. Now, I'm just going to talk to you a little bit about the key events after that, the OPEC this weekend. We've got US inflation data, and we've also got the ECB. So just going to bring up that dollar chart again as we talk about US inflation data. US inflation, we do have a couple of inflation data points for the US. First of all, we've got the PPI, which is on the Wednesday, and then we've also got the CPI, which is on the Thursday. Now, it's actually expected to tick higher to 2.9%, I believe I've seen is what expectations are. Now, again, as I said, this is posing a little bit of a conundrum for the Federal Reserve. They do obviously have a dual mandate where they're looking to support jobs as well as price stability. Now, inflation has been the sort of key concern as we hear the tariffs pushing, we've heard from Federal Reserve Chair Jerome Powell speak on multiple occasions about concerns over the inflationary impacts of tariffs. However, we also seem to be having this sort of marked cool down in the economy, or at least in the labor market, which is seems to be showing through in the US non-farm payroll reports that we've had, the ADP payrolls, the jobless claims we've seen. So there are multiple signals that the labor market in the US is weakening. Obviously, this is what we heard from Jerome Powell about at the Jackson Hole Symposium as well. So this is a case of, the Fed will be looking to support the labor market. So potentially cutting interest rates, even though we're seeing inflation tick higher. The sense being probably that any weakness in the labour market will actually pull inflation lower anyway. So it's likely to be a transitory move higher in inflation. So if we do get that tick higher in inflation, I mean, it's not going to change rate cut expectations in the sense that the 25 basis point rate cut, I think, is pretty much baked in. And, there are lots of questions regarding 50 basis points. I think if we get a hotter than expected inflation print, then that could be potential enough to keep, that would be enough to keep the the 50 basis point rate cut off the table. But I think if we did happen to see a significantly cooler than expected CPI, then that could be sufficient to support a 50 basis point cut from the Fed, in which case we could see the dollar deteriorate quite quickly, taking out that 97.5 level and potentially pushing towards the 96.5 level, which is the low that we saw in 2025. So we could see the dollar falling then to multi-year lows. Haven't seen a low that level since around 3.5 years ago. So at the same time, let's just take a look at what this is happening in tech stocks. Interestingly, so this is the Nasdaq, not trading at record highs like the S&P 500, but we did definitely have an attempt to push higher, but it failed to really settle. It's still trading now, but it's failed to remain above that falling trend line, which dates back to the 13th of August high. We are still in that rising channel though, but that's quite an ominous candle. That long upper wick suggests that there really was little demand at those higher levels. Now we're sitting above the 23,500 as we speak. If we can get a close above that rising trend line, then that would be a falling trend line, sorry, that would be significant. But otherwise, on the downside, we've also got the RSI, which is pointing downwards, suggesting momentum is fading. On the downside, be just looking at the you've got the 50 SMA and that riding trend line support there around the 23,300. Below there, this level comes into play, which is basically 23,000, which was the low that we saw on early September, and then also a level that we saw in August, and then we've got below that the 22,700, which is the August low. So as I said, it remains in that medium term rising trend, but its failure to break above that rising trend line and that long upper wick may be an ominous sign, something to be watching out for. Other big event to take place next week will be the ECB interest rate decision. So the ECB is not expected to cut interest rates. They're expected to leave them unchanged for a second straight meeting. And as inflation in the region, let's not forget, is hanging around that, it's hovering around the 2% level. Now, obviously, this, with inflation at target level, this does give the ECB the luxury of being able to wait and see sort of what the impact of the EU-US trade agreement has on the economy. Attention will be very much on the arguments that are presented by both the doves and the hawks at the meeting over whether the central bank should cut rates again. Some policymakers are concerned over actually inflation undershooting, and I think, you know, we had those concerns in the minutes of the last meeting in July, and I think, you know, those worries haven't disappeared since. And if we think about with the Fed potentially starting an aggressive series of rate cuts, which could lead to a further strengthening in the euro, look at the euro chart. I mean, we can see that that's euro is pushing above that 117 level, then that could, you know, start to bring concerns over the deflationary impact of a stronger euro. I mean, at the 117, 118, this isn't a concern. If we get to the euro at 120 around the dollar, we have heard from policymakers that that level could start to create a concern and may fuel the need for the ECB to cut interest rates. So, I mean, that's the thing. If we think about where we are in the cycle, we've got the Fed, who could be on the verge of potentially cutting rates fairly dramatically, and then we've got the ECB, who's actually finished their rate cutting cycle. So there is a potential for the euro-US dollar chart price to actually move significantly higher. I mean, if we just have a look, you know, back to 2021, the euro was obviously much stronger than where it is now, up at that sort of 123 level. So that is something to be watching out for as far as the euro is concerned. So the other thing as far as Europe is concerned, and we'll come to it in a minute because I don't think it's particularly relevant for the euro just now, is the France vote of no confidence on Monday. So we'll just watch out for this. But let's just talk first about the chart here. we've been trading very much in this holding pattern. It's down, down from that 118.30 high, but been really struggling below to move above that 117 level, and also that falling trend line. And this bullish candle here seems to be doing the trick. That's today's candle following the data. So it's interesting because although we've seen the stocks reverse, we haven't seen a reversal in the reaction in the currencies. So we've got this bullish engulfing candle rising above that 117 level, rising above that falling trend line. It brings the 118 or 118.30 back into focus. We've also got the RSI above 50 there, so a lot of reasons to potentially be bullish on euro US dollar. If that we don't get a settle above that 117 level, above that falling trend line, then just sort of watch on the downside. We've got the 50 SMA, which has been offering support around the 116.60 level on the downside, but if we get a fall below the 115.80, that's going to create a lower low, and brings the 114 level back into focus, which was the low that we saw back in August. Just going to take a quick look at what all this means for the DAX. DAX has fallen out of range here. So we did hit that all-time high in the month of August, and then we've been trading within that holding pattern, spiked down briefly, fallen now below the rising trend line support, and we're kind of coming down here. We're finding support around the 23,600 level. That's above the 23,400 that we saw as the low in August, but not far off it. We've also got the 20 SMA crossing below the 450 SMA. So reasons on the chart to be cautious, as well as the RSI below 50. We really need a break below this level, the 23,400, to confirm that sort of lower low, and to open the door to the 23,000 level, which was the low from June. What else have we got weighing on the DAX? Not only have we got those concerns over, potential that the ECB might not be cutting interest rates at this meeting, but that's not what's weighing down. You've got the you've also got the you've also got these concerns over the bund yields that we've been seeing, especially the long-dated yields in Europe, which caused a little bit of a sell-off earlier this week. This was the sell-off that we saw on Tuesday. Now that was the jump in 30-year borrowing costs for governments across Europe and across the globe, really. We saw that in Japan as well, across Western economies, amid sort of rising concerns over debt levels. Now, these are concerns that I think are unlikely to disappear very soon. Obviously, there are quite a few budgets in focus across Europe, political uncertainty as well, as governments try to or avoid making those difficult decisions of in order to control budget deficits. Similar problem in France, and that's resulted in that vote of no confidence that we will be looking at on Monday, where we expect to see the French minority government collapse after failing to be able to push through that budget, which was going to be quite draconian, to say the least, as far as French are concerned. So that it failed to get support from a spectrum of political. It failed to get support in order to be able to push through the coalition, and it's going to result in a vote of no confidence on Monday, which means continued ongoing political uncertainty. We've seen the CAC break below the 200 SMA, break below the rising trend line support, and this is where we're heading to next, 76,000. That's one to be watching for, and below that we've got the 7,500 and the 7,600 levels. Any recovery needs to get above the 200 SMA, which is sitting at 77.20, in order to establish an uptrend, we would need to be above that 79 to 80 level. So that does feel like quite a big ask, while as there's that ongoing political instability and uncertainty. What else are we going to be watching for? UK GDP. Let's just pull up sterling US dollar. This is sterling US dollar. We've got the UK GDP on Friday. UK economy is expected to show expansion of 0.4% month on month in July, pointing to a strong start to growth in the third quarter. Although it's not the third quarter, is it? Sorry, just trying to figure that out. Is it? Yes, it is. So we've got, yeah, July is the start of the third quarter, or second half, should I say. There we go. Yeah, so I mean, and that comes after the economy expanded 0.3% in Q2, and a rate of 0.4% in June on a monthly basis. However, recent PMI data has also been encouraging, with services sector expanding by more than expected. That said, there are definitely clouds on the horizon as we're seeing caution start to seep in ahead of the Chancellor's budget in November. Furthermore, there are concerns about the state of the labour market in the UK. A report that policymakers at the Bank of England watched closely showed that employer levels over the 3 months to August were 0.5% lower, amounting to the worst decline since 2021. And this is basically as firms grapple with the government's increased burden in taxes, as well as the rise in the minimum wages measures, which came into effect in April. Now, weaker than expected data could obviously weigh on the pound, but also we need to keep in mind what's happening as far as the US dollar is concerned. So if we do get any weakness in that CPI data, then we could get an increase in the sterling US dollar. But obviously, if we get weaker GDP paper, that could very much limit any upside. If we get hot inflation from the US and weak UK jobs data, then that could pull things down. So that is what we'll be watching as far as so the just looking at the levels here, we've seen sort of this recovery in the sterling dollar from that 133.50 level that was struck at the start of the month, looking to rise above that falling trend line, and also the 135.50 level, as well as the 135 sort of 90, 136 level. If we can get above that, that's going to create a higher high. And sort of, but at the moment we're just sitting in this neutral level where there's not a whole lot going on. So that's why this data in this coming week could be pivotal. That said, though, again, those concerns over the outlook for the UK in light of the budget that's coming from the Chancellor, as well as concerns over debt levels in the UK, could mean that any upside in the pound is limited. And then we just did have sorry, we looked at gold already, just the FTSE. There we go. Just falling, testing the lower bounds of that rising channel, as well as the data on the UK. We've also got China data, so now that could also affect oil as well as the FTSE, given the strong heavyweight mining stocks that we have in there. We've got Chinese inflation data, as well as imports and exports. So this is all going to be very much in focus, given that it's the second largest economy in the world, and given that the investors will be keen to see how this has all affected to see how this is affected the or how Trump's trade tariffs are impacting the economy. Just a final note on Trump's trade tariffs, actually, there will be still a lot of focus on this. Obviously, these are in the Court of Appeal. They got deemed illegal at the Court of Appeal, they'll be going to the Supreme Court. So this is going to be very much in focus, because if these tariffs that Trump applied are deemed to be illegal, then, and they need to be unwound, that could create financial chaos as far as the US is concerned, and hit the economy very hard. So that's something to bear in mind as a key theme. So not only have we got sort of, you know, Fed rate cut expectations as we head towards the Federal Reserve meeting in the 16th, 17th of December. We've also got ECB for rate cuts, and then we've also got these ongoing stresses over the Trump's tariffs and whether they will be legal or not. So lots to be watching out for, lots that can influence sentiment. So thank you very much for your time, and I look forward to seeing you again next week.